Hello everyone, this is DeLorenzo from United Asset Strategies, here to talk about the market commentary for the past quarter and where we're going for the rest of the year. I'm joined today by Thomas Healy, our Chief Portfolio Strategist, and Matt DeLorenzo, our Chief Investment Officer. Well, I can't believe that the first 6 months are already in the history books, but I can believe that the stock market was up again for the quarter. There's just so many things going on. The S&P 500, the 500 largest stocks in America, was up 8.5% for the quarter, bringing the year-to-date total at 15.3%. And the ongoing fiscal stimulus, favorable monetary policy, the favorable or successful rollout of the vaccine so far in America has really helped to fuel great corporate earnings and increased GDP. We saw a little bit of sector rotation again from value back to growth, and just at the end of the quarter, value starting to pick up again as well. The international markets are doing better, although the U.S. is continuing to outperform. All of this good news did cause a little bit of shakeup in the bond market, as the aggregate bond index is down for the year, 1.6%. But our actively managed bond strategies at United Asset are up for the year, so we're glad about that. So Matt, I would like to talk to you a little bit about what happened during the quarter. There was not just talk of inflation, there was some real inflation, but expectations for inflation and yields actually moved higher. What do you think's going on?
Yeah, so as we were coming into this year, we were pretty clear that, and pretty confident that there were going to be some big year-over-year inflation prints, and that was really just comping on a decline last March. So as we approach this spring, with prices back so much, the comparisons were going to be pretty big. So we pretty much knew that was going to happen. Really, what happened earlier in the year was the bond market tried to account for that. Treasury yields went up, inflation expectations went higher, and bond prices really came down. So that was in the first quarter. We really kind of hit a peak fear in inflation this quarter, and that helped bonds to stabilize, interest rates to come down, and it's really kind of flip-flopped where the market is kind of pricing this as if peak inflation is past us and the inflation scare is over, and we've seen the worst of it. So that's really supported the bid for bonds because the market's confident that inflation won't get out of control.
Do you think, though, we should be concerned with what's coming over the next 6 months?
Yes, because given that inflation, it's true that inflation may have peaked. We may not see big 5% CPI prints like we've seen this morning, but there's no certainty that it's going to settle out at sub 2% like it's been for so long. So if that plays out that way, where inflation does hang in there and the market continues to be, the employment market continues to strengthen, that will result in the Fed stepping back a little bit. So they could do that by winding down their balance sheet, stop accumulating as much as they are month to month, and then eventually hiking rates. So I think the next big thing for the Fed is when they're going to start to pull back, and that's going to be a closely watched thing for the market and a possible risk factor out there.
With the fiscal stimulus that we talked about almost being a tailwind for the stock markets, I'd like to call it the punch bowl. Tom, can you share if you think that this is going to continue?
Great, that's a great question. And as you pointed out earlier, fiscal stimulus has been a key driver of the economy, corporate earnings, and markets over the past 12 to 15 months. We've spent over $5 trillion in fiscal stimulus, and which equates to about 10% of GDP replacement last year and over 11% of GDP replacement this year. So it's very significant, almost unprecedented. As we look to 2022, then we create an issue because you're going to have, even assuming President Biden gets his entire infrastructure package done, that means the physical infrastructure, social infrastructure, and the tax package. As he lays out now, we're still going to end up with about 2.8% GDP replacement from the fiscal stimulus. In other words, some estimates are that we're going to go into about a $1.8 trillion fiscal cliff, something that we haven't talked about in over a decade.
With the fiscal stimulus that's already been enacted and now in place, do you believe there's other fiscal policy matters in the crystal ball to come?
Sure. That's really a 2022 issue. But if you look over the next few months, Congress and the President have a lot of work to do. in addition to trying to get this big fiscal infrastructure package done. They also have the debt ceiling, which we haven't talked about much, thankfully. That suspension ends at the end of this month. And then Treasury has also already said they have about 2 months worth of extraordinary measures that they can use to keep it from coming up against the limit, at which time Congress and the President will have to either extend it or there's a risk of default. We've been through that before. The other thing at the same time is the 2022 budget, which starts on October 1st. Again, we have a highly divided Washington trying to get a debt ceiling done, a budget done, an infrastructure package done, and facing a fiscal cliff. It's something we've seen before, and unfortunately that lends itself to market volatility and uncertainty, and that's what our team is spending a lot of time sifting through the details to figure out what's real and what's perceived.
Well, certainly not a time for complacency in the stock market, because the stock market valuations have remained elevated, and thankfully corporate earnings have been able to support this elevation. And we're starting the earnings season right now. I think we have a Federal Reserve meeting later in the month, and the team at United Asset Strategies is very busy checking all the data points that we do to make sure that our portfolios remain properly constructed. In addition to some of the things that are coming down on the policy might be, as we've talked about in prior quarters, increased income taxes, both personally and corporate, for some different tax brackets, as well as a change in the estate tax bracket and structure. So it is time for you to reach out to us if you've got any change in your financial picture, so that we can make sure that not just your portfolios are properly constructed, but that your complete financial and estate plan is as well. So at United Asset Strategies, we've continued to grow the staff, and we're ready to serve you in both the construction of your portfolios as well as your planning. We wish you a great quarter, and we'll see you next time.